Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for checking out the Market Chameleon pre-market show with myself, Will McBride, and the main man, all the way from a sunny office somewhere on the Jersey Shore, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Awesome. You want to start with the disclaimer? It's up there for everyone to look at.
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
All right.
And let me see here. I'm going to share my screen.
More earnings this morning, huh?
Yep. Yeah, we'll try to go over some of them, maybe take a look at Meta. But before we get into that, if you guys have questions and you're joining us for the first time, you can put those questions on the live chat on YouTube. Will's watching it. He'll read them back to me. If you want to come on the show and ask your question live, we also put a link out to Zoom. If you click on that link, it takes you over to Zoom. Once you get to Zoom, click on raise your hand. You'll be able to ask your question directly. You don't have to turn on your video camera. So those are two ways you could ask questions. While we're waiting for any questions to come in, we'll take a look at the pre-market report, see what's coming up on the earnings front, maybe take a look at some of the stocks that have just reported earnings. And if questions come in, we'll stop and take those questions. Sound good, Will? I think you're on mute, but.
Yep, that's good.
All right. So this is the pre-market report. These are stocks that are trading in the pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. Got 96 stocks in the percentage gainers list, 92 in the percentage decliners list. So right now, kind of a mixed bag. I would say neutral at the open. So we'll filter out this list to just S&P 500 stocks to see what it looks like in that, in those holdings. So to do that, I'm going to use the filter above here in ETF, drop it down, and this gives me a list of different ETFs. By selecting that one of these ETFs, the list below will get filtered by the holdings in that ETF. So SPY, that's S&P 500 ETF. By clicking that, now this list shows me the holdings or constituents of that ETF, which is the S&P 500. And we see 24 stocks made our percentage gainers list, 16 on the decliners. So from this perspective, a slightly more bullish bias at the open. And, important things so far, we've heard from the Fed, they raised interest rates by 0.75%. So right now, I think it reached the point where the Fed considers the rate at neutral. They're neither stimulating the economy or slowing it down. So at this point, I think they reached that level where they believe they're neutral. Up to then, I think up to yesterday, they're pretty much still stimulating, right? Because the interest rates, the borrowing rates were below the target inflation rate. In other words, if you think on average, the inflation rate is 2%, in other words, whatever the dollar buys today will cost you 2% more in the future. And if you could borrow below that rate, or if you're earning interest below that rate, you're getting punished for saving. You're better off spending the money or borrowing to spend the money. So right now, they believe we reached neutral. And I think still the consensus is we have another rate hike coming up. Well,
that's the thought. Anywhere from 25 to 75 basis points is kind of what they're talking about. So depending on these numbers, the next couple months, the inflation numbers that come out, CPI, PPI, they'll make a decision.
Right. And what's interesting right now is how the curve looks. And if you go out in time, it looks like then the prediction, the market's prediction is that the interest rates will tick up and then come back down. So what they're looking at is that the economy will slow down and the Fed will start decreasing interest rates. That's kind of what the yield curve looks like at this point. And I don't think that's what the Fed is trying to signal. They don't want people thinking that. One of the reasons they don't want people thinking that is it's counter to what they're doing, right? They're trying to tame future expectations, right? They're trying to tame inflation, which basically is people's expectations. And if the expectations are, well, we're going back down anyway, they're going to start stimulating, then it's kind of working against what they're trying to do. So that yield curve right now is not actually cooperating with what they're trying to accomplish, because they want those expectations, inflation expectations, to cool down. And I think we have another thing, just to make a, before we move on, I wanted to make a point is that right now we're seeing earnings coming out, and the earnings right now are not like horrendous. They're not bad. They're not like, oh my God, there's going to be like, companies are going to have to do mass layoffs or cut back. And when we look at the economy today, it doesn't yet fully reflect the interest rates hikes, not fully to where we are, because it takes time for that economy to feed through. And that's one of the comments actually Powell made. We're not actually feeling everything fully yet from even the previous rate hikes. That's why they're waiting for data to come in. So it's not like you raise interest rates, today up 3/4, and everything in the economy all of a sudden, adjusts immediately. It takes time for, people's spending habits, borrowing, all that to start feeding through. So even today's earnings, even though they don't look so bad, it's not, the point I'm trying to make is that doesn't mean that 3 months from now, 6 months from now, it won't feel worse because those rate hikes are not fully reflected. Does that make sense, Will?
Yeah, no, it makes a lot of sense.
There's a lag, right? There'll be a lag in the earnings. There'll be a lag in the unemployment rate. There'll be a lag, in even how we feel, right, after the interest rates are raised. So it's not as an immediate impact. So let's take a look at a couple of earnings. So Meta came out with earning. Oh, I'll come back to SPY actually really quickly. Let's look at the, we are seeing one of the things that we talk about. We are seeing SPY rallied yesterday about 2.6%. Looks like it's up today. We're just going to take a look here really quick at the seasonality. So here we're in July right now. Right now, SPY up 6.3% for the month of July. And we could see July tends to be a very strong performing month. Especially, look, we're down 8.6% in June. We're kind of rebounding here. 90% of the last 10 years, the market has been positive, right? We're at 6.3%. So if we end July here, or go higher, which we only have a couple of days, this will be the best performing July in, at least here we have like 10 years of data, right, in a decade. So that's a pretty good, it tends to do well in July. That's what the data shows. but this will be a very good performing month. And that's going into rate hikes, right? I think, what do we have? 2 back-to-back June, July rate hikes that are not yet reflected fully. And let's just take a look here. Actually, let me go back to that. Because I think we're going to start seeing probably some of the effects coming in September, October, November, December. So let me just go back to that and see where it tends to weaken. So you could see here, July, pretty good, right? That's pretty good. You know, November's pretty good. Here, August continues, you know, historically to add to some gains, not as intense. Here's the, let me see, median return, 1.4%, August versus 2.4% in July. So July and August, pretty good. Maybe some of that weakness in September, you know, because I'm watching September, market tends to be weaker, you know, out of the year. It tends to be one of the weakest, or, you know, one of the weakest months that I'm seeing, calendar months. And I think we're going to start seeing some of the impacts of those rate hikes. Let me take a look here.
We just had the doctor come in from the chat from Sub-Saharan Africa.
Yeah. Oh, welcome. Yeah, we haven't.
Jake is saying bear market rally. This rally over the last couple of days.
It's not behaving the way the Fed wants it to behave right now, right? As markets go up, people feel better. They spend more. We're at full employment already. And as asset prices go up, people feel better. They spend more. That's contributing to inflationary pressures. But let's take a look at it just from a fundamental perspective. And we see here, I kind of keep going back. Here's the earnings yield right now on the S&P 500. So this is the trailing 12 months, 4.6%. And you always have to watch where the risk-free rate is in relative terms to that. Everything will get repriced on the risk-free rate. And we're at what, between two and a quarter, 2.5. I'm sorry. What are we at right now? 2.5%, 2.25 to 2. Right. So there's a 2% basically differential between risk assets and risk-free, which I don't think that's that high, especially if you don't think, you know, we have been growing, you know, look, net income has been growing year over year, 13%. But if this comes down significantly, maybe even flat lines, that's not a big cushion right there. And here, the 3-year is at 3%. And if you look at the Fed's their forecasts, you know, they give forecasts, they have it going to 3.5%, I think, by next year. So we're still 1% away, at least 1% away from where the Fed is indicating they think interest rates will go to by like the beginning of next year or middle of next year. And that will definitely, you know, make this spread much more narrow. And the thing to think about is, as this market also increases, right? If we get this rally, you know, another rally, because we see things are illiquid, and that's what happens when interest rates go up, things become less liquid. If we rally more from here, the more you pay, right? The more you pay for an asset. If the earnings doesn't move, if the earnings stays the same, the more you're paying for the assets, the higher the enterprise value, this yield goes down, right? So the return on the invested dollar goes down as you pay more for something, but the earnings is the same. So right now, I'm just seeing this continue to contract. And when we talk about like what these companies are returning on their assets, doesn't look that high to me, right? S&P 500 right now, their return on their assets is 4%. So imagine like you bought a piece of real estate and you got rent, you bought it for 100,000, rent, you came in $10,000 a year, that's 10% cap. But after you pay, your maintenance, after you pay your taxes, after you pay, expenses, you're left with $4,000. So that's your return on your asset, right? Return on equity, not so bad, almost 20%. So the difference there is if you didn't buy sometimes you don't buy a house all cash, you borrow money, right? So if you bought a house for 100,000, you borrowed 80,000, then you only put up 20 grand. And if you earn whatever $4,000 on 20 grand, that's 20%. So that's not so bad, but look, the market is almost 4 times its book value, right? So whatever you're paying 4 times the equity right now. That's why that's shrinking. And I'm going to go to Meta right now, and we're going to take a look at maybe a theoretical value for Meta. And the theoretical value, I'm using a simple calculator just to give me a quick benchmark. When we talk about theoretical values, there's no way to get an exact value for a stock because it's based on assumptions, how much they're going to earn, what their revenues are going to grow. Nobody really knows that. So you have to give it some assumptions, and we try to use reasonable assumptions, but they're really guesses based on the information we have, the guidance, what we think moving forward is. And there are other assumptions I'm taking into my model, which is kind of different from the like DCF model and like dividend discount model. There are financial models out there. I simplified it because I pegged it to the S&P 500, to the SPY, and I'll explain why I did that. Okay, so no questions so far. Well, I'm going to move on to Meta.
All right, perfect. And by the way, this is what analysts are doing. I mean, they're not using your exact model, but they're trying to figure out and put in points, right? Of with interest rates and how they feel investments will be made and repricing stocks all the time. Here you can do it real time. I mean, a lot of these analysts, you see the repricing after the stock has already fallen, Yeah,
exactly. So we're looking at it real time. And you could reanalyze everything, right? Like you could reanalyze, well, what impact will higher interest rates have on gross margins? What impact will they have it on net margins? What impact will they have it on, interest on your debt, on your earnings growth, on your revenue growth? So each one of these will get reanalyzed, into the models. They're going to rerun assumptions, and maybe I'll build one out. The thing is, to explain it will take hours, right? If you build out a very complicated one. But each one of these will get reanalyzed and then forecast, well, what do I think that I'm going to earn? And think of it like this: if you're making an investment in a piece of real estate, you didn't intend to live in it, you don't intend to ever use it, it's strictly an investment. What are you going to look at? You're going to look at, well, how much am I expected to make in rent, right? How much? It's either you're going to, you could renovate it and try to flip it, but you can't do that with a stock, right? So it's very similar to, if I'm going to buy it and I'm going to hold it, how much rent am I going to make? And after my expenses, after I pay taxes, my maintenance, my insurance, how much money is left over, and what am I going to yield on my risk, my invested dollar, right? And that's kind of, you start thinking of it that way. But then you also have to compare that, well, what about the risk-free rate? Because if if I think I'm only going to make 3%, why would I risk money if I could just make a riskless 3% in the, in the US Treasuries, right? It wouldn't make sense. And if I'm going to borrow money to finance it, then the interest rate also becomes a factor in it, because the higher my cost of capital, higher borrowing costs, that I make less, right? Because that's going more to the bank. More of my rent is going to the bank instead of my pocket. So all the interest rates play a big factor in every asset, any asset, any financial asset that you're pricing. It's the risk-free rate is going to impact it. So let's move over to Meta here. So they reported earnings yesterday. They're right now in the pre-market down 4.7%. Here's where they're at, $460 billion market cap. And let me just go to my calculator here. Again, this is a very simple calculator just to give me an idea, right? An idea like where I think it should be priced. So I'm going to my comparative model. And right now it kind of just spits out a implied value. The machine starts to analyze, guidance, revenues, its profit margins, and it auto-fills some assumptions here. And the basic ones right now, and a lot of these models, at the end of the day, they're going to be like the most important one is revenue growth and profit margins, right? In general, that's would be the basic ones, and that will help us project how much can we earn, on our investment. So just like if you bought a piece of real estate company and you're like, okay, how much rent am I going to make, and and how much can I increase my rent year over year, right? So if I start out making rent, 10,000 this year, I could raise my rent 10,600 next year. If I could raise it to 11,000, whatever the following year, how much can I, and that will impact what you're going to pay for that investment. And here, so these are important, for what the operating margin is telling us is that for every dollar in sales the company makes, how much will I keep? So here it assumes that Meta, for every dollar in revenue, every dollar in sales they make, they keep 31% or 31 cents as profit, versus the S&P 500 right now at 13.5. So I'll change that. Let's say the S&P is 15.5. So I'm going to give 15.5 operating margins to S&P. And how much can we grow the revenue? So here, SPY, it's been growing year over year 7.4%. So S&P 500, that's the average year over year growth. And for Meta right now, because Meta gave guidance that is lower, what we did, the machine just said, okay, in the next 5 years, they might see declining revenues, then increasing. So we give it a pessimistic revenue growth of say 1%. So eventually, they might go down this year, go up next year, but 1% year over year. And I'm going to rerun it, recalculate it. And here we say, based on those assumptions, we think the implied value of Meta is $171. So I'm going to change some of these assumptions, and why I'm pegging it to the S&P is the following. When you look for an investment, right, in, let's say, real estate, if you think you could earn X amount, let's say 6% on investment, and you could go borrow money from a bank at, let's say, 3%, well, you're financing that investment, right? You figured out a way to finance an investment that is going to give you more cash flow than your borrowing costs, right? You're going to yield 6%, but you're going to borrow 3%. That makes sense, right? So you can do that also with stocks, right? If you think that the stock is going to earn, and pay out in dividends or appreciation at 6-7%, you can borrow stock. You can buy a margin depending what your broker charges you. Now, some brokers charge such a ridiculous amount, it's not worth it, but there are brokers, maybe they'll, maybe charge you 1% above the risk-free rate, let's say. So that's one way to finance it. But another way to finance a stock purchase, if you're a financial operator, is you could sell short a stock, right? So if you sell short a stock, what you're saying is the following, that at some point I got to buy this stock back, right? And if I think that the price that I buy back at, it could be higher. If it goes down, that'll be great. But even if it goes higher, just like you would have to pay back a bank, if I could take that money and invest it somewhere where it will increase by even more, then I kind of found a way of financing a purchase of a good asset versus shorting an asset maybe that I think is a bad asset, right? Or let's do maybe explain it this way in theory. If I could swap earnings, right? And if I could short one company and this company will earn 5%, but I use that money to buy another company that will earn 10%, then basically I financed the purchase by using the tools available to me. Okay. You could also short a company and earn interest on that money if you think it's just going to overvalue and go down. So that's why I'm pegging it right now to the market, because that's what the theory is. I could always short it to bring in money that I could use towards something else. Okay. So let's just take a look at the assumptions, because we could change these assumptions around. So Meta reported earnings, and I went to their press release. And what I'm going to be looking for right now is kind of their operating margins and their revenue growth. And then obviously there are more things in there that are relevant, but let's just keep it simple. And here, operating margins, 2022 fell to 29% compared to 2021, 43%. So that's not good, right? You don't want your operating margins or profit margins to fall, because that means your costs are increasing, you're making less for every dollar sale. So that is not a good trend, but we'll use 29% in our model. Let's say that will be their operating margins going forward. Total revenue, we could see here, fell 1%. So here's in 2021, they had $29 billion, whatever that is in sales, versus 28 billion this time around. So that decreased 1%. What about what they're guiding us? Here, really quickly, what stood out to me is their headcount. In 1 year, right, their headcount, it's 83,533. That's an increase of 32% year over year. That's a pretty big growth rate in headcount, especially if revenues are going down. That means these are fixed costs. You're going to have to pay these employees. They're not easy to, you have to figure out how to make them productive, right? Bringing in more revenue, bringing in. So that here, that's a big fixed cost, in my opinion, that now they're going to have to manage. They're giving an outlook here. They're giving us, what they expect, revenue 26 billion to 28.5 billion. I'm running out of time, but let's just say we take all this and what we say is, okay, operating margins fall to 29%, revenue growth, let's leave it, let's even put it at 0. Their revenue is just going to stay flat over time. If I recalculated a pessimistic view, 155, right now we're at 161. So really they're trading at a pessimistic in my opinion, already at a pretty bearish scenario for Meta. But we're already at over 930. Will someone probably under?
It's why some people are probably talking about it as a value play right now.
It's becoming more of a value play than a growth play at this point. Yeah. So
great stuff. Actually, Jake was mentioning earlier, he uses these new features so often to get a quick snapshot. It's good stuff.
Yeah, exactly.
Thanks for joining, everyone. Dima, great job as always.
Thanks. And I do want to remind, there's no exact price, right? You're just changing scenarios, trying to see where approximately do you think it would be priced. But you can't give an exact price where it should.
If we could only do that, that would be magical.
These are right. These are estimates based on assumptions.
Great job, D.
Have a great trading day. Stay safe out there, guys. Hope to see you tomorrow.